Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Richard Wheelahan, co-founder at Fund Finance Partners. Richard, it's great to see you. Thank you for coming on the show. How are you doing today?
Good to see you again, Todd. Doing great, and big fan of the content that you guys create. Big fan of your podcast and your events too. So it's nice to bring it full circle.
Well, we appreciate the kind words, and of course, thank you for your time. So if I could start off as someone who's been in and around the fund finance space for a while, how surprised are you at kind of what, at least from my perspective, seems to be kind of this meteoric growth in the space the last couple of years?
Yeah, last couple of years. For some people looking at this industry, that could be a long period of time, but I go back to 2007 in fund finance. It really didn't have a label then. And I got to give a shout out to one of the industry OGs, Mike Masha, who was my old boss at Mayor Brown, now at Everbank. But worked on some of the subscription facilities with some of the securitization technology back then. Watched it become its own, it got its own nomenclature, became its own solution, and now it's its own asset class for not just banks but other investors as well. I guess when you're in the middle of it the whole time, you never get surprised when it's meteoric or when it's a hockey stick kind of curve. I am surprised by how much coverage it gets and how frequently it's talked about, not just among ourselves, but even in larger, broader industry contexts and publications. I never thought I would see a mention of fund finance on a Bloomberg TV story or a Financial Times interview back in 2007 when I was introduced to it, but I'm a little surprised at the growth in the NAV and insurance and structured finance related spaces because of how quickly they seem to have been accepted and received, and the innovation that's taking place. It compares, and in my opinion, more excitingly than it did looking at the evolution of the subline market, which was a little bit more glacial in pace from that time.
And speaking of kind of some of the motivations around why you've seen the growth be as large, I mean, how much can be traced to kind of this depressed distribution environment we're in, from PE firms? How much can be maybe brought on by the growth of private credit more widely? Where are some of the motivations there?
Yeah, you hit up on it. It's multi. There are multiple reasons and catalysts, I think. So part of it's the demand side, where you might say depressed distribution pace. I would say longer hold periods. And then on the other end of it, the evolution of private credit as an asset class and the maturity of it and the specialization within that has created all these other avenues for yield-oriented investors to get what they're looking for in a very historically safe, very attractive risk-adjusted return kind of profile. When you talk about the growth of NAV lending and longer holds or depressed distribution rates, the case studies that I started to maybe put on the side of my desk for some other purpose, which became the NAV lending index back in 2020, 2021, those would have led me to predict that by 2025, the answer to your question would be a resounding yes. People are holding longer, they're not making distributions. It's time to finance some of that and get it back to LPs. What we've seen that did surprise me, it has surprised me, is that as little as 4% of the almost 100 NAV loans that we've indexed had a use of proceeds that was to push out capital to LPs with the financing. What we are seeing are, with a longer hold period, these sponsors aren't just there to buy and deleverage over 5 years and then sell it in an intermediate process. They are creating value, they are building things, and they are expanding capabilities for their portfolio companies. And a lot of that has been financed with those NAV facilities.
It's funny you mentioned four of the 100. I think I had Neil at ILPA on a few months back, and he mentioned it was like less than 5% of what they've tracked is, and so it's obviously very very
I wonder where
similar.
they got
But
it.
I'm curious, you mentioned obviously some of the coverage as like a little bit of a follow-up to that question. Some of the coverage in Bloomberg and others have they focused too much on some of those examples that distribution was done through a NAV loan, and maybe it's either scared LPs or maybe put them in this like what are these products versus maybe another bucket where it's just more of the evolution. Like some of that additional coverage has maybe kind of hurt you guys.
Yeah, it's not, you're absolutely right. And it's not new. I think it was in the mid 20 teens when Howard Marks wrote a letter to the FT that got published about the use of subscription facilities for, can't remember if it was private equity and private credit or just private credit managers. And I was waiting for the full-throated counterpoint to not just defend their use, but explain to the entire market what their actual utility was and what the benefit was. And the fact that, it's not, no institutional investors being deceived about the return profile of the portfolio or of the fund itself because of the use of a subline for bridging capital calls. I think some of that press I mean, you'll see in the upcoming index, we'll publish it by the end of the month, that will show less activity year over year. And I think it's directly driven by some of the publications focusing on like big deals with long in the tooth portfolio company or portfolios, generating liquidity to distribute while fundraising. And it's a tail wagging the dog. Most use cases and most applications are incredibly not newsworthy.
So tell us a little bit more about Fund Finance Partners. What does the firm look like today? Kind of where do you guys fit within the overall structure of the fund finance market?
Yeah, well, so we're a team of almost 10 people based in the US. We serve sponsors in North America, somewhat in the UK and in Europe. We've got broad coverage across all asset classes and all product formats. We work with everything from emerging managers on Fund One to those with an actual $1 trillion of AUM. Our client base has grown over time. A lot of it's repeat business. And we do have some, mega asset management clients that we still work with, but we also have a large number of clients that most are not household names with a few hundred million of AUM doing incredibly innovative things in their investment strategy or in their product development. And so I think, if you look at us in the market, we're probably like an iceberg. You see a fraction of what we're doing through deal announcements, through transactions that we're working on with lenders, investors, and sponsors. But so much that you don't see is what we do. I like to call it the laboratory, where our team is working on ideas or designs or solutions that we'd like to elegantly introduce to the market and deliver to sponsors, ultimately to the benefit of these investors.
You referenced the NAV lending index a couple of times earlier when talking about obviously the growth of the market. What was kind of the thinking behind launching it? What is the NAV lending index? Kind of tell us a little bit more about that product that you guys launched.
Yeah, well, imitation is the sincerest form of flattery, and I've always been a fan of the Cliffwater Direct Lending Index, going back to my time as a GP in private credit. And so we knew this is something that it would have to happen at some point, especially as the media coverage became more focused on more critical, I'd say. And so it wasn't just a self-serving, we've got to protect the viability of this emerging asset class, but also it's detrimental to investors to not have this be a mature, accepted, thoughtfully structured, and thoughtfully executed solution for all these different use cases. And so we published the first one last year, and it had a pretty good reception. I mean, it's been cited by by investors and other sponsors in standing up NAV products and raising capital for those. It's been cited by private equity sponsors that are using financing in that way to justify to their LPs or their LPACs. And I think it was helpful in a meeting that we were happy to participate with ILPA, with a group of NAV lenders, ILPA, obviously, some attorneys, and a lot of institutional investors. And there were a lot of misconceptions in this. It was almost like the meeting of the five families from The Godfather, or whatever it was, where it started off in a very different tone than I was hoping, with a very much presumptive sort of idea of what this product was used for and what it was. And it wasn't until I could actually put it on the table and turn pages and say, look, with all due respect, 80 something, 90 something NAV loans, this is what the data says. And
Yeah.
let's look at the actual statistics about what these things are before we just assume it's the one that you read about in whatever publication.
If you look at kind of where the market is today, where are your biggest concerns with the market?
I'm a lot less concerned about the market than I would have than if I'd answered the question in 2020 or 2021.
Yeah.
Because I think the new specialization and the innovations have proven to be prudent and accretive and have stood on their own. If I'm concerned about something, I think it may be that and it's not, certainly not critical to our market, but there are a lot of sponsors, whether they're emerging, whether they're trillion of AUM and very well covered and well known, that don't know everything about fund finance. That's shocking, right? They're in the business of managing investments, raising capital, creating value in the economy. It's not their job, but there's a lot about the stuff that they just don't think about. And it's not a concern, but it's always it may be a pleasant surprise for us when something that we may think is routine or the obvious solution in our mind, when we can introduce that to someone who's very good at managing other people's money and creating outsized returns, that there's a path here that's not nearly as difficult as the one that you may have assumed that you need to take. And so not really concerned, but the fact that there's still a lot of discovery that's going to happen out there for the client base.
What could potentially help with that, discovery? Is it funds in their earlier stage of life, understanding this more before they graduate to maybe the larger funds? Like where maybe are some of those gaps that we can maybe help close? So in
Yeah,
2 years from now, that answer is different.
yeah, I think your platform and others that are similarly thoughtful are actually doing that work. It's not going to come. It has not to date come from the I would say the global media, print media, or televised media about this asset class, because it's not the core focus of most of these teams. The other thing I think that is the other phenomenon that I've observed is when you think about the life cycle of an asset manager, it's typically born among a team of people who are managing investments, who are originating deals, who are managing a portfolio, who are attracting capital from the market, giving it back with a return. It's not the people who were the finance function typically, or the operations function, or the accountants, or the administrators. And so a lot of this stuff is that intellectual capital resides in that part of the firm, which typically gets substantial investment from those sponsors once they've gotten a pretty significant degree of scale and they become accustomed to doing certain things without having that, that data set, that repository of experience that does have those solutions and those ideas right at the tip of their fingers.
Now, on the opposite side of the spectrum, what excites you most about kind of where the market is and where it's heading?
Um, what excites me the most is that the evolution that you use the benchmark of 2 years, and whether it's the 6 years that we've been around or the last 2 years, we're getting closer to the equilibrium where there is capital in a format with expectations, with requirements that can be used to solve this issue or create this further opportunity for you as the investment manager. That's the most exciting thing to me, is we're getting closer and closer to that. I don't know if the singularity is the right word, but the convergence of opportunity and solutions is better than it's ever been, and it's only getting better.
And in talking to a bunch of people in the market, it's, been described to me that, maybe today's version is Fund Finance 2.0 or 3.0. I mean, would you say we're in those evolutions, today, or are we still kind of, 1.5.0? I mean, where would you say we are?
When you live in this, to the extent that you're an inch wide and a mile deep in that market, it's hard to say as a whole it's at one stage or the other. I think of it more
Yeah,
like, by asset class, right? So within real estate, private equity versus growth equity versus venture versus infrastructure versus credit, they're at different stages, right? Like I think real
yeah,
estate PE has been one of the most prolific optimizers of subscription leverage since the beginning of that asset class decades ago. Whereas in real estate, or I'm sorry, in private credit, for example, it's been using it for a long time, but now it's really being, I think they've been leaning into it more and getting much more utility out of it in the last 5 or 6 years, say. So I think someone like me I could never give it one number, but I could give you way too many by asset class. And I could give you a bunch of different numbers by product type, and that's our day job, is understanding whether we're at 1.0 or 3.0 in
yeah.
each part of the market.
So the lending piece of the market has evolved, a fair amount in the last few years, especially now you have these large private credit funds coming into the space in bigger and bigger numbers. And banks obviously are still playing, quite a significant role. I mean, are you seeing kind of a bifurcation, I guess is the best word, of the market, where it's like, banks are playing on this end, private credit funds are playing on this end, or are they mingling together and, cooperating on transactions? Kind of where is, kind of the lending universe, as we've seen a lot of private capital and private credit funds not only borrow, but now lend?
Yeah, good question. I'd say the coexistence is pretty copacetic at this point, and it has been since the entry of private credit and insurance into the asset class. I still think, though, at the end of the day, the depository institutions are the biggest, sort of the biggest of the five families in the room, to torture that analogy a little bit more. And a lot of private credit's being financed by depository institutions, right? So private credit coming into the NAV space, behind them, or behind all those different funds, for the most part, there's a lender in some respect, that's going to not dictate, but it's going to inform their investment strategy, their capabilities, and their expectations. I think that there's not really a demarcation in like, oh, well, this kind of a NAV facility is definitely a bank deal, and this one's definitely a private credit deal. There are some, right? Like banks are reticent to do an unsecured NAV loan, or reticent to do all PIK. That there are exceptions to those rules that we're grateful for. And sometimes a sponsor will say, even if they could get a bank deal done at a very attractive cost of capital for the fund, they might prefer the private credit provider because of the flexibility in terms, whether that's PIK, duration, or the ability to not have to siphon all proceeds to the lender to repay and be able to keep it in the portfolio and make distributions. The flexibility brought by private credit and to some extent insurance is never going to take away the bank's market share, and I don't think it's really declined market share over time. It's just expanded the range of solutions available, and it's made adoption more widespread.
And one thing I'm always curious about is, you have credit funds are acting as borrowers, lenders, insurance company are acting as borrowers, lenders. You have banks obviously playing a big role as lenders. There's an SRT angle to this. Like, it feels like risk is kind of being passed around, and it's kind of like this circle that, eventually will kind of spin off the wheel, at least from the outside looking in, as someone, who's in it every day like you. I mean, how do you think about kind of the risk of, some of these firms that are borrowing and lending, and it's kind of like this commingling of risk amongst all the participants? Like, how do you view that? At least from my perspective, it looks a bit, potentially risky at some point in the future.
Yeah, anytime you've got streams of capital crossing or circling back, it's natural and it's probably prudent to at least be suspicious or inquisitive about it. Again, with this being our day job, our observation, and I think collectively our firm's observation, is that even though that capital's cycling through potentially among the same parties or in the same format, that risk maintains its stratification. And the depository institutions, whatever part of the ecosystem they're in, are taking depository institution risk and nothing else. And the counterparties and the utilizers are incredibly sophisticated borrowers, or in some cases, private credit lenders who have been very thoughtful about their expansion into this. And frankly, as an asset class, at the end of the day, where's the risk? As an asset class, whether you're talking about subscription facilities, credit fund ABLs, private equity NAV loans, rated note structures, they've all had some scrutiny at some point, but the default rate is minuscule or microscopic, and in some products, the loss rate's non-existent. And so I think it's a combination of the prudence of the parties that are utilizing these or providing the solutions, as well as the performance to date and the risk adjusted, the risk profile that the market correctly calibrates.
So, a lot of the various markets that we cover, we have a CLO conference, obviously structured finance, ABF conference, asset-based finance. We do private credit, direct lending. It feels like you can't have a conversation with any of those individual groups without fund finance coming up somewhere in that conversation. I mean, how interesting are the structures starting to become, and what innovation kind of is most interesting to you when it comes to more of the structuring side of things, as more structured and private credit kind of have
Yeah,
entered the sphere of fund finance?
I love that. That's honestly where I probably spend too much of my time is product evolution. So I think insurance, the two themes, insurance, particularly after the NAIC's firmed up guidance on risk-based capital charge and bond treatment for investments in CFOs or rated note feeders or rated note funds, private CLOs, you name it. That has clarified where they can identify opportunity, I think, and has brought that capital into the market. And the other side of that is asset-backed credit. And that could be secured term debt in a fund finance context, or it could be true asset-backed finance or ABS. I think that's a virtuous cycle where, and I remember this at the ABF conference last year that you guys put on, where I said at some point the fund finance and the ABS or ABF conferences of all things are going to sort of converge, and they're going to sound very similar to each other. And I think that's been good for the market. It's been good for the investors in the asset class, and it's been good for the investors that are benefiting from that financing.
What areas of the market you think are still underserved?
Um, you know, the the story about asset management, if you look at fundraising articles and AUM concentration, it always feels like the haves and the have-nots. And that's probably a little bit too cruel of a metaphor, but so much of the capital that's coming into the market is coming into so few sponsors that are multi-strat, large, well-established kind of managers that no allocator's ever been fired for allocating to. On the other hand, the vast majority by number of GPs are not those firms. And the extent to which those firms who are doing incredible work for investors, they're doing incredible work in the economy, frankly, they don't have the same access that some of those larger, more established groups do. That's a prolifically underserved segment of the market. I don't think it's because of any suspicion or bias against them. It's just too easy for the largest sources of capital to serve the largest managers of capital. It's just too efficient. So I don't really fault anybody for that. But we've worked with a lot of good lenders and fund finance providers. Some of them, household names. Some of them, when we introduce them to our clients, they may not have heard of the institution, who are doing a good job of serving that segment. But I think subscale NAV loans, the minimum size for a lender to want to do a NAV loan was one thing in 2020. It's a lot bigger now in 2025. And there's still a lot of good, I would say, subscale NAV loans that need to get done. Similarly, GP commitment financing and management company financing, that use case has gotten more mature, and that's a difficult product, relatively speaking, to install compared to a subscription facility for a $3 billion committed capital private equity fund.
Well, picking up on that note, what makes it so much more difficult than your typical private equity fund that you just mentioned?
All right, so say you're a big money center bank and you're the head of the fund finance business, and you've got an allocation of the bank's balance sheet of a certain number of billions of dollars for the year in fund finance, and you can tackle that with a few very large credit facilities for very large and established sponsor borrowers. That's a pretty easy, like, work smarter, not harder. That's
Yeah.
a pretty easy way to accomplish what your institution has tasked you with doing, versus going over, it's not kissing frogs, but actually looking for innovation, off the radar opportunities. People are trying, but it's just so much easier to address the large segment than it is to put in 50 loans with that allocation as opposed to five.
Yeah. Got it. What would you say is if there is anything particular that's missing in the market, where would you say what is that or where is that in the market?
I should be careful with this one. It's I think more risk, right? So, you know, there's a there's a certain there's a certain red line when you say you're a credit manager looking for back leverage, or there's a certain red line if you're a NAV borrower where it could be asset level diversification, minimum diversification or max concentration. There could be, eligibility criteria for certain financings that have, don't get me wrong, that discipline has benefited all of us in maturity and the success of the market. But it's, as an arranger of this kind of stuff and as a former GP, I'd like to see more. I'd like to see a little bit of credit policy relaxation, specifically from the banks. Although I get it why it's limited in its viability, but from the non-banks and the insurance companies, a little bit more, permissiveness without taking undue risk is definitely warranted, I think.
So we have a couple minutes left before we get to our fun questions, and then obviously out the door. But I, referenced it at the top when I introduced you that you're a co-founder at Fund Finance Partners. Kind of what led you to becoming a founder? I always think it's an interesting part of the story. I've interviewed lots of founders in my 20 years in the conference industry, and curious to always know kind of what made you take that leap.
Yeah, I still don't think of myself as a founder for some reason. I think of founders as like guys in turtleneck sweaters that are really tech savvy and with their, sitting on a panel with their legs crossed on a couch, but and a headset microphone. But I grew up thinking I was never going to be a founder of anything, that I was not very risk tolerant. My dad was a company man, worked for the same, Fortune 100 company his entire career. I never thought of being a founder was going to be appealing because of, well, who's going to take care of the operations? Where's my resources? All that kind of stuff.
Yeah.
But as a GP for 10 years, I loved doing this stuff. I loved being in the laboratory. I loved wins. I loved making stuff work. I loved growing AUM through with thoughtful debt providers versus just raising equity capital. And the opportunity to do this for any number of different sponsors that are like, it's like having, it's expanding your base of friends, and a lot of people with different views and different backgrounds doing that same work that I love with a team that we put together that I love. So you're on a great team, and you get to play all over the court, all over the world, and you get to pick your spot. So that's been the best part, and glad I did it.
What's been the biggest lesson learned since you started until today?
Um, from starting until today, it still feels like we're flying a airplane at 30,000 feet while we're still building it. And so I guarantee you that I've not learned whatever the biggest lesson is yet. But the biggest lesson I've learned to date is probably resilience. And it's not a pick yourself up by the bootstrap, hard scrabble beginning of the firm by any means. Zach is a brilliant guy. He's been a friend of mine for a long time. And I never had any doubt that we wouldn't be successful or that we would regret it.
Mhm.
But it really takes resilience to do that. You're never off. Whether it's Super Bowl Sunday at 3:30 p.m. and you're working on a model for somebody that hasn't even signed an engagement letter yet. That investment in people, that's our personalities, right? That's how we act. That's how we treat our friends and our family and our colleagues and everybody else. But then when it becomes your job to do that, then it's not an option. It's just it's an ethos that you have to adopt, and it's not for everybody. But we have a good team to make it work.
So we have a few fun questions, a bit lighter as we get close to wrapping up here. First one is a favorite sports team or hobby.
Uh, well, that's a tell. Grew up in New Orleans, big LSU, New Orleans Saints. That's my favorite stuff to watch right there.
LSU needs a little help with their offense.
They do. If I got to find another podcast for that. I can talk about that for 45 minutes.
Well, I'm a Notre Dame fan, and so you took Brian Kelly from me, and
Most Notre Dame fans thank me for that.
yes, I do.
That's
Especially because I think Brian Kelly got to the point where he thought what he could do at Notre Dame, there was a limit to it. And I think
right.
NIL came along as well. At the same time, there was this evolution in the game itself that
Yeah.
Marcus Freeman has clearly said, all right, we can exceed what we've done before. And I don't think Kelly's to me still one of the top coaches in the
Yeah.
game.
Yeah. The results speak for themselves. I
Yeah.
also think, and hopefully, hope he's not listening. Don't take offense if you are, Brian. You got good taste in podcasts, but feeling he reached that ceiling at Notre Dame, which is crazy to think that there's a ceiling at Notre Dame of all
Yeah.
institutions. But then I think thinking if I just do what I did at Notre Dame, success will come on its own at LSU in the SEC. I
Yeah.
think that's a little bit of a cognitive dissonance that if I had to assess it as a non-psychiatrist might be there. Other than, my eyes bleeding watching LSU's offense right now, my favorite hobby is probably watching my kids compete. My daughter's a competitive ice dancer, and my son is an absolute unit who plays defensive tackle, and those are fun to watch.
Tell us one surprising thing about yourself.
I'm not a big fan of the outdoors. I I think I've been camping once in my life, and I live in a golf course and don't play. And I'm a big fan of air conditioning and a nice hotel in a big city.
What would be one book that you would recommend reading?
Oh, there's a real raunchy one that my one of my uncles gave me for Christmas when I was 14 or 15, wildly inappropriate. It's called Venus on the Half Shell, written by a pseudonym, Kilgore Trout, I think. It's an allegory and it's raunchy and it's hilarious. But seriously, one book I recommend reading to everyone is Ralph Ellison's The Invisible Man. It's another allegory about the Harlem Renaissance and racial identity and racial identification and the lens through which people look at a particularly crucial time in the country's understanding of that.
Most exciting part of your job?
Um, when I think it's not when you close something, and it's not when somebody hires you, but it's when somebody reaches out, maybe it was a referral from another client, or they saw something on the web, or they saw something like this, and they have a question, and then the thought process starts, and it leads to creation. Like that's one of my hierarchy of values is at the top is creation through struggle or hard work, and so that comes about between those two phases, and that's the most exciting part for me. It's the actual creation and the progress toward the goal.
And then final question, one prediction for the next 12 months.
Next 12 months. I could make some predictions about college football coaches who I think will be looking for new jobs. Um,
The
I could
Saints
make
getting the number one pick.
and what do they do with it? And I could make a prediction about interest rates, but my prediction for the next 12 months is that UNC will win the men's college basketball championship.
Well, and on that note, Richard, I really appreciate you taking a few minutes and joining me today. Continued success, for you guys at Fund Finance Partners, and we look forward to seeing you again sometime in the future.
Always, my friend. Appreciate your time.
Yep, thank you.
Yep.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.